Oh, I was not muted. I was muted. I didn't unmute myself. So let me restart that. What is going on, sad boys and gals? And welcome to our stream. Welcome to another crypto safety school stream. We have our live chat going here for those of you who are watching after the fact on the recording. So those of you who are live, you can say hi to those who are in the past here. Y'all are in the future for them. So if you are new here, the goal for these crypto safety school streams is to make crypto easier to understand, practical, and useful for you, especially if you're just new to crypto or just getting started with trading crypto or just getting started in the ecosystem of crypto and just curious, how it all works. Imagine fading the stream. Um, in the crypto safety school channel on the Discord, we'll be posting our classes. These will be 7 to 15-minute recorded videos with walkthroughs, handouts, and even homework with prizes for top scorers. Think PBU back in the day. Those classes will be launching soon, and these weekly crypto safety school live streams will be linked to those the classes of the week. But for now, we're just going to be going over different beginner-friendly topics revolving around crypto for these live streams. And the recording, as we were already talking about how it is recorded, is going to be this is going to be available for everyone as well in that live recording channel of our Discord with all the previous live sessions. So today we are going to be talking about stable coins. We're talking about what they are, why they matter, and how they're used in crypto and just beyond. So whether you're trading using it for DeFi, decentralized finance, or just looking for a way to move your money around more efficiently, stable coins can play a huge role in the financial ecosystem and possibly in your future financial ecosystem, or for some of you who already use USDC or other stable coins, you already are using it. So we'll also cover different types of stablecoins, some that failed and how they compare to traditional banking, different risks and benefits, and just what happens with regulations and stablecoins, and what we can look for in the future. So by the end of this, hopefully you'll have a solid understanding of how stablecoins work and why they're so important, and hopefully you'll also be able to win some of our trivia game at the end here, going over stablecoin questions, and win some sad tokens for those of you who are here live. So before we dive in, I just want to ask y'all in the chat here live, how many of you have used, bought, or sold a stablecoin before? If so, just drop the name of the one or ones that you've used in the chat. It could be USDT, USDC, anything goes. And if you haven't used one yet, that's cool too. Just say that, no, just say I haven't in the chat. And, if that's the case, this session will hopefully give you everything you need to know just to get started when it comes to the basic education of what these stablecoins are. All right, so I see USDC as a very popular one. USDT back in the day, USDC, USDT. Yeah, USDC and USDT is a very popular one here. Euros is top. So yeah, no, definitely. Yeah, Solana. Well, eventually. Well, not I guess not eventually, but definitely. Anyway, Solana and Bitcoin are popular coins, but I wouldn't. Those are not considered stable coins. Luna, Luna says cowboy. We'll be talking about Luna here in a little bit for those who don't know, and I think that probably will end up being a trivia question if I'm not mistaken. So let's just start with the basics and just what is a stable coin? My plan is to move 80% of my portfolio into USDC this year. You're getting ready, you're getting locked and loaded for that bull market, right? So, and we'll talk about what that even means for those who don't know. So a stablecoin is a digital asset, just like crypto or NFTs. These are digital assets that are pegged to something stable. So a stablecoin is something that's pegged to something stable. Typically, it could be the US dollar, but can also be pegged to gold or other currencies, or even a basket of assets, like almost like an ETF would be. So the whole point of a stablecoin is to give you the best of both worlds, which is the speed, efficiency, and just global accessibility of crypto, but without the wild volatility of crypto. Because as we all know, if you have, if we are looking to buy the sad boy dip, if you have a bunch of money in Solana, well, Solana goes down too, then you're losing money while you're waiting to buy your sad token or waiting to buy whatever token it is. We're going to be talking about how having your money into stable coins keeps you away from that volatility, but also, you can still have crypto in your wallet, kind of like the cash on the side, like we talk about in the stock market. So instead of worrying about, Bitcoin, Ethereum, or Solana swinging, 10% in a day or a week or whatever, stable coins let you hold that value more predictably, which makes them more useful for trading for those who want to have cash on hand in their wallet without worrying about price fluctuations. It's also useful for those who use crypto to make payments and just other DeFi or decentralized finance use cases. And we're just going to talk about how that works as well. Yeah, locked and loaded for the bear market. That's even the best time to be locked and loaded, honestly, and ideally not over allocated. So not all stable coins are the same. Some are backed by real assets, some are backed by crypto, and some try to use algorithms to maintain their stability. And each type has its own strengths and weaknesses. So if you're using stable coins and trading or DeFi or just holding them, it is important to understand this and also understand how to look up and understand what it means and what's backing your stable coin and the risks that come with it, which we're going to be talking about. So we're going to break this down into three main categories. We have the fiat-backed stable coins, the crypto-backed stable coins, and the algorithmic stable coins. So let's start with the most common type, which is the fiat-backed stable coins. These are the simplest and most widely used stable coins, so backed by the US dollar, or is this backed one-to-one by real-world assets? Usually US dollars have in reserves, or usually these have US dollars held in reserves, but they can also be backed by other fiat currencies like cash equivalents or short-term government bonds. Every time one of these stable coins is issued, an equal amount of cash or cash equivalent assets is supposed to be held in a bank or financial institution to back it. So these are backed. So for example, the US dollar backed one-to-one by the US dollar. So in theory, whoever this issuer is, whoever this coin is, the company behind the coin, they should have an equal amount of US dollars on hand, or not like in their hand, obviously, but held in a bank or in a financial institution to back it. Some of the most common stable coins like this are USDT, also known as Tether, which is the largest stablecoin by market cap and issued by Tether, and USDC or USD coin, which is issued by Circle and is often seen as more transparent than Tether. So Circle, which is the USDC one, provides monthly reports that verifies the USDC is fully backed by reserves, whereas Tether has faced scrutiny over the years for its lack of transparency. So Circle is a US-based company which operates under, because of that, strict regulations, being US-based, and is registered as a money service business, the MSB. So they do a really good job to comply with stablecoin regulations, whereas Tether is known for being less than cooperative with regulators and has had fines in the past over misleading reserve claims. There was also BUSD, so that's Binance USD, which I think will also be a trivia question for those of you who want to win some SAD tokens later, who are live in the chat. So that's Binance USD. BUSD was previously issued by Binance and Paxos, but was shut down due to regulatory concerns. So some other stable coins you can look up, or you might have heard of, are USDD, PYUSD, which is PayPal USD, First Digital USD, FUSD, and there's also True USD, TUSD. So a whole bunch of them out there, all backed by by different different assets or currencies or whatever it may be. So how do these work? So if a company issues 1 million USDC, it should have $1 million in bank reserves or US treasuries to back it. So, these stable coins are similar to cash in your bank account. The difference is that your bank account is insured, while stablecoin reserves are only as good as the company backing them. So if the company managing the stablecoin is transparent and fully backed, like USDC claims to be, then it's relatively stable. But if the company is secretive or just under-regulated, there's always a risk that the reserves aren't fully there. So there have been some instances where stablecoins have depegged. So they were backed by an asset, this, that, whatever, and that's how they maintain their one-to-one pegging. And in this case, they got depegged. So there's Terra USD, that's UST. Anybody get So I remember when anyone get caught up with the whole UST and the Luna debacle. That was a huge thing in the news. I know Cowboy mentioned it earlier in the chat, talking about Luna. But Terra USD, UST, was designed to maintain a $1 peg through a mechanism with its sister token, Luna, LUNA. A large withdrawal from Anchor Protocol triggered mass selling, which was more than the system could handle, which caused UST, the stablecoin Terra USD, to depeg, meaning it was no longer $1. When this happened, more mass selling was a response. People saw it depeg, and then they're like, I don't want to be in this because it's probably going to crash. And because everyone thought that and everyone took their money out, it was kind of like, we talk about the indicators, how, if everyone uses the indicator and uses a certain moving average as support, and because of that buys at the support, is going to be a support. The same deal happens here. Everyone thought, oh, well, this thing's going to depeg, or it has depegged, and it's going to keep going down because everyone's going to pull their money out. So I'm going to pull my money out. Well, because everyone thought that and did that, it did start to crash. So the company, started printing more Luna to try to restore stability, but that only just flooded the markets with the worthless tokens and just made things worse. So I think it was $40 billion was wiped out due to all this. So that's a concern, or a big risk when it comes to these stable coins, and that's why you want to look into the backing of these stable coins. If you're going to be getting into stable coins and putting your money into stable coins for whatever reason, you want to know what your stable coin is pegged against, and if they are transparent about it. Just because you say, hey, we're pegged to $1 million US, but if there's no way to actually regulate them, or to see that they actually are pegged to it, it's just words. So I learned a hard lesson about the importance of self-custody, not your keys, not your crypto. Oh, for Celsius. Yep. That's a big thing. That's something we'll also be talking about, not today, but just in general with these classes, the KYC and the importance of it. Because I know, especially as time goes on, there's gonna be more government regulations with crypto, and just getting them being more involved in crypto, and just even Google and Apple and whatever already with Phantom Wallet. There is going to be a lot more centralization around the decentralized cryptocurrency that is worth discussing, just understanding as well when getting into crypto. So USDT has also depegged in the past during crypto market crashes. So market panic led to large scale transfers of USDT to real US dollars, as people just wanted to exit the crypto market. They it was like the end is near, and they figured, oh, the market's crashing, crypto's unstable, it's not backed by this, that, whatever. It's going to crash to zero. Bitcoin's going to zero, whatever. I'm getting out of this thing. I'm going to get all my money out of crypto and put it into USD. And a lot of people have their money in stable coins. And so when everyone does that in masses, well, what could happen is that USDT could depeg, which has happened in the past. This caused, questions over Tether's actual reserves. USDT always recovered, but the trust concerns didn't fully recover. USDC also has depegged in the past. During the Silicon Valley Bank crisis in 2023, it did depeg. But as we learned in that crisis and crises following, and even before that, banks are also susceptible to things like this happening. So just because your money's in a bank doesn't mean it's 100% safe, or not 100% of it is always going to be safe, because anything can happen. It's in any financial institution. But of course, crypto has less regulations and is way more risky than a central bank. For depending on who you ask, I guess, and depending on what you're looking for when it comes to how your money is being stored. So once the U.S. government stepped in to guarantee the SVB, the Silicon Valley Bank deposits, USDC did regain its peg. Iron, IRON, was a stable coin as well, that kind of like Terra UST. It was backed by a volatile crypto token. In this case, this one was 75% backed by USDC and 25% backed by Titan, which is the volatile crypto that I was talking about. Titan had a crash in price, which caused Iron, the stablecoin, to lose its peg. Titan went to basically near zero, making Iron near worthless, and it's delisted now, I believe. So there are risks that come even with stablecoins and just all stablecoins, but even the ones backed by the dollar, there are also risks. The ones we just went over. The first is your counterparty risk, meaning you have to trust that the company is actually holding the reserves. Like I said before, just because you say you have $1 million US dollars in reserve to back to peg it to peg this this stable coin, doesn't mean you actually have it. You want to make sure that the company is transparent about their holdings, and can back it up, and is backing it up. The second is regulation risks. As the government can starts to and can crack down on stable coins, like they did with BUSD, you should be more careful about which ones you're getting into. The third is freezing risks, since centralized issuers have the power to freeze or blacklist funds. So that's another thing just to keep in mind, when you're getting into just any coin in general. So just think of it all like a bank. You want to do your due diligence in which bank you choose. You don't want to just pick some random shack on the side of an abandoned street that just has the words bank written on it, and give your hand your cash over to some person in that bank. Like this, you don't want to do that. You want to make sure you're picking a trusted bank, one that one that people have used before, whether it's Chase or Wells Fargo, whatever. Just like when picking a stable coin, you want to make sure it's one that that you've heard of, that other people have heard of, that is legitimate. And then you want to really get into how it's being run, just like with banks as well. You want to make sure that you're not getting putting all your money into like a Silicon Valley bank or a First Republic or something that could crash, just like with the stable coins. So let's move on to crypto-backed stable coins. So unlike the ones that are backed by the dollar, which rely on banks and companies, crypto-backed stablecoins are backed by crypto assets locked in smart contracts. So these stablecoins do not require a centralized company to issue them, which makes them more decentralized. So instead of holding US dollars in reserves, crypto-backed stablecoins are backed by cryptocurrencies such as, could be Ethereum, Bitcoin, other tokens as well. Because crypto is volatile, these stablecoins need to be over collateralized, meaning that for every $1 of stablecoin issue, there's typically more than $1 worth of crypto locked up as collateral, because the price of crypto can go up or down. If the price of the collateral drops too much, the system automatically liquidates positions to maintain stability. So one of the most well-known decentralized stablecoins is DAI, which is issued by MakerDAO. So if you want to mint this token or the stablecoin, you can deposit Ethereum, lock it up in a smart contract, and borrow this DAI against it. The system ensures the value of the collateral always stays higher than the amount of the stablecoin issued. So there are some risks to be aware of with crypto-backed stablecoins. The first is, of course, volatility risk, which is always going to be the risk with anything crypto, is always going to be volatility. Since if the collateral crashes too fast, the crypto collateral, liquidations might not happen in time. And the second is smart contract risk, because if there's a bug or a hack in the code, your funds could be at risk, just like with a bank. If your bank gets hacked, this, that, whatever, it could be a risk if you don't have a bank that's, well funded when it comes to the FDIC or, your insurance or whatever. The third is that they are more complex to use and understand than the stablecoins such as USDC or ones that are backed by the US dollar. It's just easier to understand $1 is $1 when, as opposed to, $1 equals this amount of crypto, and this is how we regulate it and make sure that it stays this way. And, it's a lot more confusing to do your due diligence on that one. So now let's talk about the most experimental and risky type of stablecoins, which is the algorithmic stablecoins. So instead of being backed by cash in a bank or crypto locked in a smart contract, these stablecoins rely on algorithms and game theory to maintain their peg. So instead of using real collateral, algorithmic stablecoins try to maintain their peg through supply and demand mechanisms. So when demand is high, the system increases supply to lower the price, and when demand is low, the system reduces supply to increase the price. The system increases supply to lower the price when demand is high, and when demand is low, the system reduces supply to increase the price. This is supply and demand, mechanisms basically, and mechanics. So these adjustments are usually done through minting and burning a second token that work alongside the stablecoin. So as we were talking about earlier, a famous example of one of these is Terra UST. It was designed to stay at $1 through that mechanism tied to Luna, its sister token. So when UST went above $1, the new UST was minted and Luna was burned. And when UST went below $1, UST was burned and Luna was minted. So in theory, this balancing act would maintain the peg. But like we went over before in May 2000, I think it was 22, UST lost its peg. Terra Luna gives me PTSD. Yeah, I remember making a bunch of videos about that one. And that basically led to a death spiral after it lost its peg, where both UST and Luna collapsed, wiping out billions of dollars, just in general. So with these, once people lose faith in the system, there's really no backup plan, then the stablecoin fails completely. So it's great, when it's working, but when people start, not trust it anymore because it is its algorithms, then once the trust is lost, it's game over for those kind of stablecoins, which is one of the big risks. So for example, if we're not doing this, but if we were to create like a stablecoin right now, and peg it to to SAD token, and SAD token was to crash or whatever, then anyone who had that stablecoin, would probably end up depegging and crashing as well. So that's kind of what happened there with like the UST and Luna debacle. So this type of stablecoin, as all stablecoins, come with risk, but these ones come with major risks. First, there is a collapse risk. So if people lose faith, the peg breaks and the stablecoin can go to zero. Second, there is this, no real collateral. Like unlike the US dollar backed or crypto backed stablecoins, there's nothing really holding up the value of these algorithmic based stablecoins. And third, they are highly experimental, and no algorithmic stablecoin has really successfully held its peg for the long term as like as an experiment. You want to see successes out there, before really getting into these. And so there really hasn't been any that have really tested the time as when it came to being stable. Not much stable about algorithmic stable coins. Yeah, exactly. Mad Fisher. So now we've covered the three main types of stable coins. So we have the ones that are backed by US dollar, or other currency like that, and that's the most common. And these are backed by real cash reserves. Then you have crypto-backed stablecoins, which are decentralized and backed by crypto collateral, but require over collateralization. And you have the volatility that's impacting all that with crypto in general. And then the algorithmic stablecoins is to try to use supply and demand, and try to make sure the price stays stable in that within that regard. And these just have a history of failure. So not all stablecoins are created equal. Some are safer and more reliable, while others are riskier and more experimental. And then some are even just not as trusted. So if you're using stablecoins in trading, DeFi, or just as a cash alternative, you need to know what's backing it and what risks come with it. So you just like with any stock, crypto, NFT, any asset, any forex that you're getting into, whatever, you want to do your due diligence first. So now that we understand how stablecoins work, and remember, we're going to be doing some trivia about this afterwards. So now we understand how it works. Let's get into why they're actually useful. So one of the, and we already went over, or we asked people in the chat which ones they use, and I know Cowboy said Luna, but a lot of people do already use USDC, and other stable coins as well. I use USDC all the time. Just to, right now, my crypto is in USDC that I use to day trade or this, that, whatever, because I don't want to keep it in Solana or something else that could go down. I want to keep it in an asset that's staying at $1 as my cash on the side. But I also don't want to just like not have it in my wallet and like have it in my exchange or in my bank, because then if something happens in the market, like the Trump coin or whatever that I want to get into, I don't want to have to wait to transfer my money into my Coinbase and then transfer my money from my Coinbase to my wallet and then eventually buy. I want to be able to buy it right away, and so USDC is our way of doing that without having to just keep it in Solana or in Bitcoin or in Ethereum or in something that has the risk of going down. So one of the biggest use cases for stablecoins is trading. Crypto markets are highly volatile, and traders often need a safe place to park their funds without having to completely exit the crypto space, or like I was saying before, without having to take your money out of your crypto wallet. So a lot of people just use, like I was saying before, this USDC as cash on hand, or just their stablecoin as cash on hand. Stablecoins also increase market liquidity. So because they allow traders to quickly move in and out of positions without relying on traditional banking systems, they make the entire market more efficient. So without stablecoins, traders would have to continuously cash in and out of your bank or of your exchange, which would be slow and expensive, honestly. And so, they are very much needed. This is also why most crypto exchanges, both centralized and decentralized, use stablecoins as the base for their trading pairs, instead of USD. So, instead of seeing BTC USD, you'll often see BTC USDT or BTC USDC. I'll write in the chat what that means or how that looks. So that's what, instead of BTC USD, you'll often see, like I wrote in the chat here, the BTC USDT. Stablecoins also play a crucial role in DeFi. If you ever hear the term DeFi, what people are talking about is decentralized finance. So if you ever used lending platforms, staking, or yield farming, then you've probably seen stablecoins being used in these systems. There are DeFi, or decentralized finance platforms, that allow users to lend and borrow stablecoins in a decentralized way. So there's DAI is an example. And here, let me take a little screenshot here so you can see. This is CoinMarketCap. Some of the top stable coins by market cap. So by CoinMarketCap, this is talking about market cap. So you got your Tether, your USDT up there, your USDC, and then you got your DAI as well up there, number 30 overall, but number 4 for stable coins. So DAI is a decentralized stablecoin that users can mint by depositing collateral like Ethereum into a smart contract. So now let's say you have $10,000 in USDC sitting in your crypto wallet. Instead of just letting it sit there, you could deposit it into Compound or another DeFi platform like that and earn interest. Just kind of like putting your money into a savings account, except the interest rates in DeFi or decentralized finance can often be much higher than what you get at a traditional bank because there's more risk involved in crypto. So because you're putting your money into something more risky, your bank savings account, it's going to stay there. Typically, especially if you're like a Chase or whatever, you're not putting in ridiculous amounts of money. No matter what happens, you're going to have access to that money, unless like the world ends or whatever, in which case we have way more things to worry about, than our Chase bank account. But with crypto, and we've seen, a lot of different crypto platforms out there, they've either they crashed or, regulations happened or this, that, whatever, or they weren't being transparent or whatever it is. And something happened and people lost a lot of money. So, there is more risk involved. And because of that, they need to give you more incentive. Just like, why would I put my money into this when I could put it into that? Well, here's why, because we're going to give you more money in return, as your, APY or whatever it may be. And that's exactly what it is. And that's why you need to do your research, into these things, because just because the APY, I can earn 20%. Well, if your coin goes down 80%, well, then what's the point? So that's why, due diligence is so important when it comes to anything, with your money. Even buying, groceries or whatever, you always want to do due diligence. You go buy an apple, you're going to look at the apple, make sure it's not moldy. You're not just going to pick the first apple you find. Make sure there's not a worm in it or whatever. You same deal with your stocks, same deal with your crypto, and same deal with your stable coins. You want to make sure that there's nothing wrong with it. You want to look for red flags. And some people just do a quick, look. They'll look at the apple really quick, throw it in their cart. Some people will, feel the apple, make sure it looks good all over, this, that, whatever. Everyone has a different way of doing their due diligence. Some do it quickly, and some do it, a little bit more, a little bit longer. They go down. Showed us banks aren't as safe as we thought. Exactly, Mathis. And that's why, Bitcoin even became a thing. It was after 2008 that Satoshi or Satoshis or whoever's Satoshi is, that's why Bitcoin was created, because 2008 did show us that banks aren't as safe or transparent or as trustworthy as we thought. And even after that, even recently, with Silicon Valley and First Republic, banks do also crash, just like exchanges do, and just like anything can crash. And so there are definitely arguments on both sides when it comes to the validity or safety of your money in any asset class. But everyone has their opinion. There's a million people who tell you the stock trading is a scam. And then a lot of people here know that, it's only a scam if you get scammed and follow scammers. Banks make money with your money in risky ways. Yeah, that's true. So this is why, this is what makes stablecoins a very key part of DeFi, decentralized finance, because they provide liquidity for lending, borrowing, and yield farming. So since stablecoins hold their value while earning interest, they're a much safer choice than using volatile assets like Bitcoin, Ethereum, or other cryptocurrencies that are even more volatile than those two, in these types of protocols. So think of it like a high yield savings account, but instead of earning like 0.01% or whatever it is interest at your bank, DeFi protocols might offer 4 to 8% or even more, depending on market conditions. Of course, this comes with risks, but the ability to use stablecoins in these systems has revolutionized the way that people think about saving and investing. When you get billions in important, yeah. Yeah, that's true, Quackers. Another major use case for stablecoins is remittances and international payments. So traditional banking systems like wire transfers and Western Union are slow and expensive, especially when sending money across borders or just overseas, a different country. With stablecoins, you can send money instantly at a fraction of the cost. So let's say you want to send $500 to a family member overseas. If you go through a traditional bank, you might have to wait 3 to 5 business days for the transfer to clear, and the bank might take $25 to $50 fee on top of that. If you use USDC on a blockchain like Solana or Polygon, you can send that same $500 in seconds with a transaction fee of less than a penny, typically, obviously depending on the network. It's faster, cheaper, and doesn't require a bank account. So all the recipient needs is a crypto wallet. So, if this person doesn't have a bank account for whatever reason, because banks, are, decentralization is all about, anyone can use it, for the people, by the people, we're not going to exclude anyone. Whereas, of course, banks, you need to have, your driver's license, you need to have this, that, whatever, possibly good standing. So, if you want to send money to someone who doesn't have all those things, this is one way of doing it. This is why stablecoins are becoming popular in emerging markets. It's also why they're very popular in illegal markets, honestly. But where people don't always have access to traditional banking. They provide a stable store of value in economies suffering from high inflation and unreliable banking infrastructure. So imagine living in a country where your local currency is losing value every day due to inflation. You imagine, right? Instead of keeping your money in hyperinflating national currency, you can convert your earnings into stablecoins like USDT or USDC to protect your wealth. This is already happening in places like Argentina, Venezuela, where people are using stablecoins to avoid their currency's rapid decline. I'm just going to see what the chat's saying. To the bank, yes. Oh, yeah. Stablecoins aren't just useful for individual payments, however, they're also being adopted by businesses. So, it's being adopted just by the masses. More and more companies are choosing to accept stablecoins as payment because they're cheaper and don't require the involvement of banks. Us the penny boys, we know, I think Nikki's still in here, or maybe not. But there's just so many fees and stuff involved in just anything that, involves banks and, WAP or Stripe or whatever, there's all these fees. And, with crypto, that's not the case. So this does make them, a viable alternative to traditional payment processors like PayPal or Visa, which charge high transaction fees. So stablecoins and crypto are becoming more and more common as mass adoption continues, which is just the case in general, with crypto and just Web3 in general, which is why we are still early. Excuse me. In fact, stablecoins actually now settle, I think, more transaction volume annually than even Visa does. So that's one thing to think about. It's definitely not just some little thing that, like just a few people know about. Now it's really becoming highly adopted, as we see, in commercials, Super Bowl, this, that, whatever. Governments and central banks have also taken notice. And so, the big question is, will stablecoins and just crypto in general remain independent, or will governments take control of digital money? In Europe, the Markets in Crypto Assets Regulation, the MICA, is the first major law that directly regulates stablecoins. So under this regulation, under MICA, stablecoin issuers must be fully transparent about reserves and meet strict financial standards. So companies issuing stablecoins must register with European regulators and ensure their coins are actually backed by real assets. This means stablecoins like USDT and USDC will face more scrutiny in the European Union. This is why Crypto.com and others are delisting Tether, USDT, and other tokens like it by January 31st, that's tomorrow, to comply with MICA regulations. I'll actually leave a little link here for y'all, for those who are interested in that kind of stuff. In the United States, regulations, I know a lot of people are probably seeing that in the news right now recently, so it's good to understand why. So in the United States, regulation is still in progress. U.S. regulators have targeted certain stablecoins, like when the SEC forced Paxos to stop issuing BUSD. There's also a talk of a stablecoin bill here in the United States, which could require all stablecoin issuers to be regulated like banks. If this happens, only government-approved companies would be able to issue stablecoins, which would reduce the number of stablecoins in the market. One of the biggest threats to stablecoins is the rise of CBDCs, central bank digital currencies. And I'll write that down in the chat for y'all too. That's CBDCs, another thing you're going to be seeing in the news a lot if you haven't already. These are government-backed digital currencies that operate on blockchains, but with full control by the central bank. Some countries like China, the EU, and the US are actively working on their own CBDCs. China has already launched their digital version of a CBDC. The European Union is working on a digital euro, and the US is researching a potential digital dollar. CBDCs are designed to function like stablecoins, but with one major difference. So a private stablecoin like USDC or USDT is managed by a company, whereas CBDC is controlled directly by a government. Then you have the decentralized ones, like the algorithmic ones, or ones that could be backed by, different, mostly the algorithmic ones. These are the ones that are decentralized. So these are not as you don't have to worry too much. Like if you are in one of those kind of backed currencies, you don't have to worry about those regulations happening in a decentralized anything, because that's for the people, by the people, regulated by the people. CBDC gives governments control of your money. Yeah. Yep. That's exactly what it is. So yeah, think of it like a digital, bank almost by the government. If CBDCs become widely adopted, governments could limit or ban privately issued stablecoins. This would give central banks full control over digital money and allow them to track, freeze, or even program how money is used digitally. So some people worry that CBDCs will eliminate financial privacy when it comes to crypto, as governments could have the power to monitor every transaction. Others believe that they could improve financial inclusion by making digital money more accessible, and more people, in theory, quote unquote, would trust it because it's backed by the government. But that kind of defeats, in my mind, that kind of defeats the whole point of cryptocurrency, and just of why Bitcoin was formed in general. So the question is, will people choose to use CBDCs, or will they prefer privately issued stablecoins that offer more independence? Another key debate is the future of stablecoin for the future of stablecoins is centralized versus decentralized options. So centralized stablecoins like USDT and USDC are backed by real world reserves, but require trust in the issuing company. Then you have your decentralized stablecoins like DAI and Frax and others, which are backed by crypto collateral or algorithmic mechanisms, which makes them less reliant on a single entity. So if regulators or regulation targets centralized stablecoins, we possibly could see a shift toward decentralized alternatives. So DAI, for example, is backed by Ethereum and other crypto assets instead of fiat currency. Because of it operates through smart contracts, there's no single company controlling it. However, decentralized stablecoins have their own risks, such as reliance on volatile crypto assets and potential smart contract vulnerabilities. So, the real question is, can decentralized stablecoins see a rise in a world where governments regulate or ban centralized ones? So if the government says, the only way to have a stablecoin is for it to be through the government, or in order to have a centralized stablecoin, well then maybe the decentralized ones might see a rise because all these other centralized ones that aren't government based might get wiped out. So the last thing I'll say before we get to the trivia is that in order to use stablecoins safely, you need to understand what backs your stablecoin. So you don't want to just throw money randomly into a stablecoin just because it has the word stable in it. It doesn't mean it can stay stable forever, as we've talked about some that have failed in the past. So you want to understand what backs your stablecoin. Is it fully collateralized or algorithmic? You want to stick to stablecoins with strong transparency and audits, ideally. If you are really concerned about about the stability of your stablecoin, transparency is the best way to know that your stablecoin is stable or that it is backed by legitimate U.S. dollars or whatever it might, what do they say they are backing it by? And also, just be aware of regulatory risks. So, governments can shut down stablecoins like they did with BUSD, and they might regulate others in the future, like we're talking about with if they create their own stablecoin and make it so you have to be government backed in order to have a centralized stablecoin. So you need to be careful about that, because that could shut down some stable coins, and it could affect you if you are in those stable coins. And also, just never assume a stable coin is 100% safe. Even the best ones can depeg in extreme situations. So nothing, your money's never safe anywhere really, but that stays true with stable coins too. So they are powerful, but like everything in crypto, you need to know the risks and you just need to know how they work before using them. It's really tempted to get into the crypto market, especially when you see Trump coin popping up and everyone talking about Dogecoin and other meme coins like Pepe and Peanut and whatever, and everyone's talking about all these gains. But before you even get involved in trying to chase these gains, you want to understand how cryptocurrency just in general works. You want to understand what a wallet is, what an exchange is, what the difference is, what the different wallets are, there's pros and cons of each. So, you can really understand where you're putting this money, because, making hundreds of thousands of dollars is great and all, but if you get it stolen from you because you clicked a faulty link, or, you threw it into a stable coin that you thought was stable and it ended up not being stable and it depegged and you lost all your money or whatever, then, it defeats the purpose of making all that money in the first place, because then you just lost it. And so learning how to keep your money is the most important thing before even learning how to make it, because you don't want to make it and then lose it. So that's why we're teaching these things here in this crypto safety school. The bottom line is, though, that stable coins are here to stay in one way or another. Whether it's through trading, DeFi payments, or global finance, they become an essential part of the crypto world and will continue I believe, to shape how digital money is used in the future. So now that you all hopefully know more about how they work than the majority of the world knows, now it's time for some trivia. So I'm going to go ahead and end the recording portion, and we'll do the trivia here for those who are live in the audience. For those who are watching after the fact, I hope you tune in next time live. That's going to be on Thursday, 1:30 p.m. Eastern. But until then, I hope that you all make some bread.